Tap. For a moment, nothing happens. Approved, but the store has not been paid. What moved was not money, it was a request. A request that may cross a provider, an acquiring side, a card network, and the issuer. Some validate, route, or assess risk. The issuer returns the answer. The beep is only permission to continue. Approved is not paid. The journey begins across a gap of only a few centimeters. No cable, no physical contact. Card and terminal communicate through a short-range wireless field. The exchange lasts only a moment. Despite the word tap, they need only be held close enough. It does not simply announce one reusable number. Each in-person contactless payment carries a transaction-specific security value. Tap again, and that value changes, making copied data far less useful for another valid tap. The terminal adds the amount, merchant, payment credential, and other transaction details. Together, they form an authorization request. Neither knows your balance. The terminal can only send a secure question outward. Card payments do not follow one identical route everywhere. Local networks, closed-loop cards, offline approvals, and single-message debit systems can work differently. But a common four-party model gives us a clear map. First is the cardholder, the person initiating the purchase. Second is the merchant, the business accepting the payment. Third is the acquiring side, the institution and payment providers connecting the merchant to the wider card system. A processor may carry the technical message even when an acquiring institution holds the formal relationship. Fourth is the issuer, the bank or financial institution responsible for the account behind the card. Between the acquiring and issuing sides sits the card network. It supplies standards and routing, allowing institutions with no direct relationship to exchange payment messages. The authorization request travels outward: terminal, processing and acquiring side, network, issuer. The response travels back: issuer, network, acquiring side, terminal. These are roles, not necessarily separate companies. One provider can perform more than one, and the physical route may remain inside a single country. The network can be global. The individual payment does not have to travel around the world. At the far end of the request, the issuer has to make a decision. It can evaluate whether the card and transaction appear valid, whether sufficient funds or account capacity are available, and whether the request conflicts with security controls. Risk systems may also contribute a score. The exact inputs vary, but they can include transaction details, merchant behavior, identity or device signals, account history, and broader patterns across a payment network. This creates a difficult trade-off. Approve a fraudulent purchase, and someone in the system may absorb a loss. Decline a legitimate purchase, and a real customer is stopped while the merchant loses a sale. So the decision is not merely, is there enough money? It is closer to, does this request look valid enough under the rules that apply right now? If the answer is yes, the issuer returns an approval. It also typically reduces the amount available for other purchases. On a debit account, that can appear as a pending amount. On other card accounts, it can reduce the remaining spending limit. This temporary reservation is called an authorization hold. If the answer is no, the issuer returns a decline. The terminal normally shows the shopper only the short result, not the complete decision process behind it. Many signals have now been compressed into one word. Approved. This is where the experience on the surface and the machinery underneath separate. The cardholder may see the transaction as pending immediately. The merchant receives enough assurance to hand over the purchase. To both people, the payment feels finished. But in a typical dual-message transaction, authorization, clearing, and settlement are different stages. Authorization allows the purchase to proceed. It is not normally the final movement of funds into the merchant's bank account. That separation matters because the final amount is not always known at the first moment. A hotel can request an estimated authorization before the final bill exists. A fuel station can reserve an amount before it knows how much fuel will be dispensed. If a transaction is canceled correctly, an authorization may be released rather than completed as a normal sale. The approval is therefore a coordination of trust. The merchant lets the customer leave because the issuer has signaled that the transaction may move to the next stage. The goods can move before the money does. After authorization, completed transaction details move into clearing. The timing and implementation vary, and some providers group completed sales into batches. Clearing is the accounting conversation. The acquiring and issuing sides exchange the financial records needed to post the transaction, reconcile what happened, determine the obligations between institutions, and assess the fees that apply. Settlement is the financial completion of those obligations. A network can calculate each participating institution's net position, then facilitate the transfer of funds between issuers and acquirers. In the representative flow we are following, the merchant receives proceeds later, according to its provider agreement and payout schedule, after applicable acceptance costs have been deducted. There is no single global clock. The schedule can depend on the market, provider, merchant agreement, weekends, risk controls, and the type of transaction. This difference between fast authorization and later settlement explains several familiar experiences. A purchase can remain pending before it becomes final. A released authorization is not the same event as a refund. A merchant can finish a day with many approved sales, while the proceeds are still moving through the financial back end. The customer experiences a beep. The institutions experience a sequence of messages, ledgers, obligations, and transfers. The customer sees one purchase. Behind it, a card payment creates a small economy, accepting it has a price. The merchant usually pays a card acceptance charge through an acquirer or payment provider. Interchange can be one component, generally transferred from the acquiring side to the issuer. Processing, network, and other services can add more. There is no universal percentage. Rates vary by market, provider, agreement, card product, transaction type, and qualification rules. That is why a sale and the merchant's proceeds may differ. A transaction creates both revenue and cost. Pricing creates incentives. Merchants seek reliable acceptance. Issuers want useful cards. Acquirers and processors sell services. Networks benefit when legitimate payments use their rails. The same system that coordinates trust is also a market. It allocates fees, revenue, information, and risk. Bargaining power can differ by market and merchant size. A tap hides 3 questions: who pays, who earns, and who sets the terms. The system is designed to remove friction. 3 steps become 1 tap. That convenience is real, but easier payment can also make the act of paying less noticeable. A 2024 meta-analysis combined 392 effect sizes from 71 papers on spending and payment methods. It found a small but significant cashless effect. On average, spending tended to be higher with cashless methods than with cash. The effect varied by context and generally weakened over time. A pattern, not a rule for every person or purchase. That does not prove every tap is manipulation or that cash is always better. But when payment feels almost invisible, whose friction disappeared and whose restraint went with it. Now remove one node from the map. If the terminal cannot reach the merchant's processor, the authorization request may never leave the checkout. If the acquiring side cannot reach the card network, the request cannot follow its normal route. If the issuer is unavailable, the outcome depends on arrangements between the issuer and network. A network may use stand-in processing to make an authorization decision on the issuer's behalf. That fallback is conditional, not universal. Otherwise, a payment may be declined or retried. Visa says its network follows a 6-9 standard, 99.9999% availability. That is Visa's claim about its network, not a guarantee for every terminal, bank, processor, or connection. The chain succeeds when a global system feels like a local appliance. We notice the chain mostly when one link stops answering. Return to the beginning. The card is still above the terminal. On the surface, almost nothing has happened. Underneath, a one-time security value helped form a request. Providers and institutions routed it. Risk systems may assess it. Normally, the issuer returns the decision. Later, clearing and settlement begin the slower work of reconciling records and moving funds between institutions. Around that machinery sits a market whose incentives reward reliability, speed, and near invisibility. Tap, beep, approved, 3 simple moments on the surface. Underneath, technology, money, risk, and influence. The most successful systems become invisible. Invisible systems deserve the closest attention. This is world's back end.